question. Alrighty, can y'all see that okay? Let me pull it onto my center screen so that way I'm not staring off onto one of my other screens and I'm looking right at everybody. So first off, big thank you to all of you for being here tonight and taking the time to learn more about HOA insurance and not only helping yourselves, but helping all the members of your community. That's a big testament of you all as board members, and also, of course, big thank you to Cedar Management for having me with you all here tonight. I'll do my best to answer any questions and educate you the best that I can. So without further ado, I'll go ahead and get started here. So directors and officers liability insurance and how not to use it, because obviously no one wants a claim to happen, but if we have a claim, we want to be sure that we have the proper coverage in place so that our insurance policies cover that claim as intended. So tonight, what we're going to actually discuss to start off on part one is the two main types of D&O liability coverage, which is going to be the endorsed coverage and the separate standalone policy. And I'm going to get into the details of the two as well as the differences as well. And before we move further, as you see at the bottom, I am Hunter Lideker, Vice President of Lideker Insurance. My contact information will be at the end of the presentation, so please feel free to reach out with any specific questions or anything I can help with. So community associations background. There's over 330,000 community associations in the United States. More than 63 million Americans live in association-governed communities such as condominiums, homeowners, planned unit developments. So the point here is that there's a lot of people that are affected by the way that a community association is run, and making sure that it's run appropriately and protecting the community is a big deal because there's a lot of people that it can affect. So what exactly is directors and officers liability insurance? So you'll hear me actually refer to directors and officers liability insurance as D&O. That's just a short acronym for directors and officers liability. Rolls off the tongue a little bit easier. But so what it does is D&O insurance actually helps community association board members to sleep better at night without worrying that their personal assets are at risk because of a decision, action, or inaction that they make on behalf of the board. And so board members, what you all do on a daily basis is interpret and enforce the association's governing documents, and you all have the fiduciary duty to make decisions as a reasonably prudent person and to make decisions that you all believe to be in the best interest of your association. And so what this D&O insurance does is, like it says there in the first bullet point, is that if there's an action or inaction or decision or indecision that's made or not made that then leads to a negative financial consequence, D&O insurance is there to kind of help make you whole again, as long as it's something that's covered and subject to your deductible. And on D&O policies, typically a deductible is referred to a retention. It's very common to have a retention of $1,000 or maybe $10,000. Those are very common increments for a retention. So why do we need D&O insurance? Of course, even with board's best efforts, their actions can lead to potential lawsuits alleging breach of contract, breach of fiduciary duty, employment or housing discrimination, slander or libel, or a host of many other potential claims. Lawsuits can seek monetary or non-monetary relief, and a good D&O policy will cover both. But as I mentioned in the very beginning, we've got two main types of D&O coverage. We've got the endorsed coverage, and we've got our separate standalone policy too. But there's pros and cons to both, and depending on what your objective is, it kind of depends on what shoe is going to fit best for you. An endorsement is going to actually be the least expensive way to provide D&O. And kind of funny, I don't really like the way that I explain that they're the least expensive way to provide D&O coverage, because the thing is that the endorsement, while yes, on the front end, it may be less expensive, on the back end, if there's not coverage for something, then you're going to be paying for that endorsement, and then it may not cover everything either, because as you can see on the other bullets that are listed there, the coverage is attached to the general liability, but it excludes third-party discrimination, non-monetary claims, and many other things. So that's why, as you see there in the last bullet point, I like to refer to it as covering from A to C. The separate standalone policy is going to cover us more so from A to Z. It's going to be more expensive on the front end, but on the back end, in my opinion, it's more important to have a guaranteed cost up front and know that if a claim occurs and it's something that could potentially be covered some way under the sun, this standalone policy, the right standalone policy, should cover you. And that's why I say, it's a guaranteed cost, and it is more expensive up front, but in the long run, it's all about the value, and you get what you pay for. So this full separate policy is actually a separate policy from the general liability, but it's going to include coverage for third-party discrimination. It's going to include coverage for non-monetary claims, defense for breach of contract, employment practices. It's going to cover your property manager in association with their duty to you all and your community. There's even, with the right policies, you've even got a lifetime occurrence reporting provision. So what that means is that, let's say that tomorrow that you all decide, you know what, I'm done with this board stuff. I can't do it anymore. Too much for me. Takes up too much of my time, whatever it is. And 3 weeks down the road, there's a claim that comes in for something that occurred, or a decision or action or inaction or indecision that was made while you were on the board. Well, now that you're no longer a board member anymore, somebody sues the board and the association, you may not have coverage there. But the thing is that this lifetime occurrence reporting provision allows coverage for even once you're no longer a board member anymore. So if, later on down the road in the future, when you're not a board member, somebody sues the association for something that occurred while you were a board member, that full separate policy, when written the right way, is going to provide coverage for you, even though you're no longer a board member. And that's really important. So again, endorsement covers A to C. The separate standalone policy is going to cover you from A to Z. So we'll go ahead and continue to kind of talk a little bit more about that. So what we've got here is going to be what I see as our top 5 causes of D&O claims. And so what we've got is failure to adhere to the governing documents or a breach of covenants. And we're going to go in further into detail into each one of these further on in the presentation. So I'll just kind of list them all here now. We've got challenges to decisions of the Architectural Review Board, challenges to assessments or collections, a board's failure to maintain common areas, as well as a decision by the board resulting in physical damage to property. So we'll go ahead and kind of get into those a little bit further, so we can talk about kind of some of the things that may lead to that. So the first one that we've got here is failure to adhere to governing documents or breach of covenants. So as you know, y'all should, as board members, be familiar with your documents, your CC&Rs, covenants, conditions, and restrictions, as well as, your bylaws, rules and regulations, all of your governing documents for your community. Now, where you can get into trouble is with some of the things, especially listed right here. So the first one being selective enforcement. We've got to be sure that we don't just because somebody's our friend and, and we're on the board, they're not on the board, but they're friends of ours, and we want to try to help them out and look the other way. If your legal documents say that you have to do something a certain way, you have to do them that way. If you don't like the way that they're written and you all as a board feel that you don't want to continue to do it that way, then what you need to do is you need to amend those documents. So you either enforce the rules as they're written to everyone, not using selective enforcement, but using equal enforcement across the board and treating everyone the same. So either enforce the rules as they're written, or get together with your HOA attorney, work on drafting an amendment and presenting that to your association to change those, so that way you're not going about things differently than what your legal documents are saying you're supposed to. Because if you do something that goes against those legal documents, you're opening yourself and your community up for trouble. Now, one thing that we do have on our side as board members is we've got a legal statute that's referred to as the business judgment rule. And so what that's saying is it's going to provide us some indemnification for our actions, decisions, and indecisions with regards to, if any other prudent person would make the same decision in those same circumstances, that that statute is going to be there to protect you. But again, the point of our D&O policy is to make sure that you sleep well at night. And so that if something does go to court, if someone does try to sue the association and come after you all, not only do you as board members have protection, but the neighborhood has, as a whole, has a financial resource to go to other than their own bank account to deal with whatever situations may arise. So again, kind of with the last bullet here, the last thing we've got is our good faith dealings. Everything that you do with regards to your duties as a board member should be in good faith. You just going back to the first bullet point there, selective enforcement, we cannot do that. Treat everyone equally with good faith and put your best foot forward, and it'll help prevent from having a claim from occurring. So failure to adhere to the governing documents and breach of covenants is actually the single biggest exposure for condo homeowner, property owner, townhome associations in general. Just all associations this is going to be our biggest exposure. It's actually 1 in 3 claims allege this failure with regards to D&O claims anyways. And again, this is going to be talking about things where we're not adhering to our covenants, conditions or restrictions or bylaws. That's going to represent the contractual obligations of the community and the way it's supposed to be run. So as you can see, there's a little graphic here on the right with a pie chart showing you some different types of claims, with 35% of claims actually coming from breach of contract, and then 25% from non-monetary claims, and 40% made up of various other D&O claims. So one of our next most popular is going to be challenges to architectural review committee decisions. And just like before, same rules apply. We need to treat everybody equally. No selective enforcement. There needs to be an even-handed application, meaning that everyone's treated equally. Arbitrary and capricious decisions. So again, everybody treated equally, just like it says in the third bullet point there, harmonious and consistent. And so what we need to do is be sure that not only do we review the guidelines that are in our governing documents with regards to the architectural review, but we need to be sure that we're treating everyone equally. If we allow house A to put up a certain type of fence, then we need to allow house B, C, D, and E to put up a certain type of fence. We can't treat people differently. So one big thing to keep in mind here is that when we've got architectural review guidelines, oftentimes those are things that are going to be fall under what we consider non-monetary claims. It's kind of like you see in the picture there. Somebody in your neighborhood decided to decorate their house all up and paint it like a Hello Kitty house, and obviously that's against your architectural review guidelines, because everybody's supposed to have natural looking exteriors and natural colors on their home. You can't have hot pink according to this neighborhood's guidelines. But so what y'all are trying to do here is get this person to paint their house or change it back to the way it's supposed to be. And you need a legal decision from the court to tell these folks that that's what they have to do. So in that case, there's no money loss with regards to the association itself. So that's why this falls under a non-monetary claim. And as we mentioned earlier on, an endorsed D&O policy is not going to typically cover your non-monetary claims, but your full separate standalone policy will cover non-monetary claims. So when you have things such as, the Hello Kitty house in your neighborhood, or, if we go back a slide or two, we've got the mailbox over here that looks like a little revolver. We don't want that. We need to get rid of that stuff because it doesn't follow our architectural review guidelines. And those typically fall under non-monetary claims. So if you have to go to court for it, if you've got the endorsement, it's probably not going to cover you. So again, it's better to have the right coverage up front, have a guaranteed cost, spend a little bit more money, and know that you've got things that are going to be covered. So our next slide here is going to be with regards to challenges to assessments and collections. So oftentimes where we see this come into play is with people questioning the way that you calculate the assessments or overcharging them, and in that same breath, whether it's regards to the interest or late fees, whether maybe they disagree with a late fee or the amount of interest that's accrued on their account. Those are all things to be aware of, and that people will come after the association for if they feel like they're being taken advantage of. And so again, by having the right coverage in place, we know that we're covered. And two places where we can kind of get into trouble is if we don't follow the guidelines of our last 2 bullet points, which is the Federal Fair Debt Collection Practices Act and the North Carolina Debt Collections Act. I don't have a ton of information on the specific guidelines of those, just since I'm more on the insurance side of things. But from my HOA attorney friends that I know, they tell me that these are 2 things that get folks into trouble a lot. So be sure that you're following both of these guidelines to be sure that you don't have a claim come up and that you have to deal with. So one of our next most common claims on the D&O side is going to be failure to maintain common area. And so what this is often going to be relative from is lack of maintenance on the common area combined with a personal injury claim. So whether that's a sidewalk in your neighborhood that has a crack in it, and somebody trips and falls and injures themselves, not only are you going to have to worry about covering for their damages from their injuries in the community, but also repairing that sidewalk. And again, is this sidewalk crack something that the association already knew of and that for one reason or another they decided not to fix, or maybe they didn't have the financial resources to fix it, which in that case often will raise another question, which is our bottom bullet point here with regards to mismanagement of funds. If the association knew about the damaged sidewalk and chose to do nothing about it or couldn't do anything about it because they didn't have the funds to do so, it could present an issue with regards to mismanagement of funds and not properly funding reserves and having money on hand to take care of regular and ongoing maintenance, such as things like that. So as you see there, the second bullet point, lack of reserves. Like I said, lack of reserves can lead to poor management of common areas, which then can create bigger problems on your hands. So whether it's, a sidewalk has a crack in it and someone trips and falls, or another thing to be aware of is let's say that your neighborhood has a pool or some other kind of amenities, and for one reason or another, the association has chose not to keep up with those amenities, but the members of that association are paying dues for the enjoyment and use of those amenities that they now do not have the benefit of enjoying because they have not been maintained and kept up with, even though they're paying dues to go towards that maintenance. So again, just things to be aware of. Be sure that you keep up with maintenance and are doing regular checks around your premise to make sure you don't have any exposures that could prevent or that could lead to injury or claims. So another one of our most common items with regards to claims and D&O insurance is going to be a decision by the board resulting in physical damage to property. So whether this is, the maintenance of the common areas, kind of like the stuff that we talked about before, or even maintenance of property owned by a homeowner caused damage. And so what I mean by that is, let's say you live in a townhome association where you as the owner are responsible for insuring the townhome itself, the building interior and exterior, but maybe the association is responsible for performing gutter cleaning and exterior maintenance and things of that nature. If the board, for whatever reason, maybe it's lack of funds or something else, decides that they're going to forego that maintenance and gutter cleaning, and your gutters get clogged up with leaves, and you get a big rain, and that rain backs up and causes damage to your home. The fact that the association didn't perform the maintenance like they were contractually supposed to do led to the damage in your home, which you insure and you're responsible for. So that's a place where, if we're not doing the things that we're supposed to be doing with regard, in this case, the maintenance aspect of things, and there's damage to a owner's home, that can lead to a D&O claim. The last bullet point that I have down there is an extending a patio into common area. So this is something I actually have experience with personally. For those of you that don't know me, I'm actually like I like to refer to myself as a recovering board member. I was a board member in my previous community before my wife and I moved into the community we live in now. It was a townhome community. There was a gentleman in the an owner in the community that wanted to extend his patio out into the common area. But the way that our documents were written, every owner in the association has equal ownership of every piece of common area, every piece of grass, anything like that in front of or behind the unit, the way our documents were written. Well, this gentleman, was like, oh, well, the way he saw it is nobody else used that little, 10, 15 foot stretch of grass in front of his patio, and it would be great to extend his patio out there to spend time with his family. But the thing that he failed to realize to consider is the fact that everyone equally owns that piece of land. So if we would have allowed him to extend his patio, it would have been opening us up for a big can of worms, because that's not his land to extend onto. That everyone in the association has an equal interest in that land. So by denying his request, we were actually protecting ourselves from opening up a potential D&O claim. So I talked before about monetary versus non-monetary claims. So just real quickly, monetary claims are those involving some type of direct tangible loss, such as a fire destroying a building or hail damage of a roof. A non-monetary claim would be those involving no direct monetary loss, such as defense costs associated with litigating a case. And like I've mentioned a few times throughout, the big thing here is that D&O may not cover non-monetary claims. So what are we going to do to avoid some of these common claims? We're going to follow the rules and the current rules. Like I said before, if you don't agree with the rules, that doesn't mean you can just bend them or break them. You need to properly amend them. So follow your rules or amend them. Memorialize your actions. So that means minutes. Take minutes for your meetings. If that way you record everything, you have proof. Elect board members who are serious. Don't elect people that are just there to, have some vengeance with their neighbor, or to do something that doesn't make sense. You need to elect people who are serious about the benefit of your community being kept up and the values of your homes, being where they should be. People that aren't serious are just going to get you into trouble. Be sure you use your professionals. So with any type of vendors, whether you're using your Cedar Management professionals and the folks that they recommend, or someone like myself that's an insurance professional, use your professionals and lean on them and ask them for their opinions and recommendations. This is what they do every day. Don't let emotions and personality get in the way. Neighbor judgment versus business judgment. Like I said earlier, business judgment is making sure that you do just what any other prudent person would do in the same situation. Neighbor judgment can get a little bit emotional and personal. We need to be sure to treat this as business, not personal. Immediately forward demand letters or lawsuits. That's a big one. There's a provision in just about every insurance policy about timely reporting of claims, because the longer we wait to report a claim, the more potential damage that claim can cause. So the sooner we report the claim, the more likely we are to not only have coverage, but have a sufficient, quick, and concise outcome. So how to maximize the outcome of the claim: provide notice as soon as reasonably possible. Cooperate with the insurer in its investigation. So whether it's assisting in collecting facts or sending them documents, the quicker we are and more efficient we are, the more efficient the process is going to be. We need to cooperate with appointed counsel. A note there is that your insurer appoints your counsel. Just because you have an HOA attorney that you all use regularly, if you submit a D&O claim, your insurance company is the one that has the right to appoint the counsel for you. The only way they may allow you to use your own counsel is if your counsel agrees to the hourly rate that they pay their appointed counsel, which in my experience, typically the appointed counsel is a good bit less than someone's general counsel or preferred counsel. So that often causes an issue sometimes. So be sure you cooperate with your appointed counsel. Be prepared to evaluate settlement proposals, whether it's prior demand letters, lawsuits, employment contracts, governing documents. We need to be sure to have everything together and be prepared to evaluate those along with any settlement proposals that come together from the insurance company. So what this chart here is really just here to show is that although the cost of the standalone policy is a good bit more expensive, starting at about $750 a year versus about $200 a year on the endorsement, it provides much more coverage, as we've talked about here. So again, we've gone through the standalone D&O versus the D&O endorsement as we've gone on. So rather than saving everything like we would in person to this portion to kind of have a back and forth question and answer with regards to some of the claim situations I've talked about and how it would be affected with a standalone versus an endorsement, we've kind of done that as we went along here. So I'm going to go ahead and move along to the next portion, which is going to be the workers' compensation for community associations and why every single association needs workers' compensation, whether they have employees or not. So to start, what exactly is workers' compensation insurance? Well, workers' comp is a type of insurance that provides benefits to employees that suffer work-related injuries or illnesses. So in the state of North Carolina, workers' compensation insurance is required if an employer has 3 or more employees. And a big thing to remember here is this third bullet point. Just because you aren't required to have workers' compensation insurance doesn't mean you can't be responsible for workplace injuries. So if something happens, whether you're a business owner or in your case, obviously you're a community association and you have a contractor that gets hurt on your property and they're uninsured and your association doesn't have workers' compensation insurance and you all are found liable for their injuries, just because you don't have a policy doesn't mean that you are no longer responsible. It just means that now that's going to be coming from the HOA's bank account instead of an insurance policy. So why does every association need workers' compensation insurance? Because even with their best efforts, workplace injuries can lead to damages and lawsuits. A general liability policy is going to provide coverage for bodily injury, but it's going to exclude bodily injury to an employee. And the reason is that an employee should be covered by workers' compensation. So general liability excludes that. So if we have a trip and fall from a homeowner walking around the community, walking their dog, that's going to be something covered by the general liability. But if we have a contractor or uninsured contractor that gets injured on the property during their time working there, then that's not able to be covered by general liability. So if we don't have workers' compensation in place and we're found responsible, then we're going to be paying out of the bank account. So associations work frequently with vendors. In the case of workers' comp, it doesn't matter whether the vendors are hired directly by the board or by the management company. The same problem can result if a vendor's employee is injured on the property. Many associations assume the vendor would be the only one held responsible for their injured employee, but the law still allows the employee to sue the association too. This is most likely when the vendor did not have proper insurance in place, leaving the employee nowhere else to turn. So what this can mean is one of two things. Maybe the vendor didn't have insurance at all, workers' compensation insurance at all, or maybe they had very low limits and it's not enough to cover the injury. So this injured worker has to look elsewhere to try to fully recover from his loss given this injury. So even in cases where the association did its due diligence and required the vendor to prove its insurance status, this can end up being problematic if the vendor allows the insurance to lapse or if they provided falsified information to begin with. Unfortunately, I'm going to go out on a limb here and say most vendors are not going to falsify their insurance, but unfortunately, there's some bad apples out there in any world. But what happens more often than not is that maybe somebody forgets to make a monthly insurance payment, or maybe their payment gets stuck in the mail. Like right now, the U.S. Postal Service is so slow, and unfortunately, if people are mailing check payments, then things can get mixed in translation and unfortunately cancel. And if a policy cancels and an injury occurs, again, that doesn't forbade the responsibility for coverage there. It just means that somebody's bank account is going to be involved unless there's another insurance policy available there. So 2 common claims: an employee of a contractor is injured at the association and the employer is not provided proper coverage. The association may be required by the local labor and industrial authorities to step in as the employer as it relates to benefits owed to that injured employee. So that's what we've been talking about a lot of up until now on the workers' comp side. Now, another thing to be aware of, especially with folks like yourself in a community association, is that a volunteer working on behalf of the association, if they're injured during the course of their duties, the association could ultimately be responsible for their work-related injuries as well. In the case that volunteer was, let's say that it's a community member that's volunteering to do some gardening around an entrance monument, or a community trash pickup day, and someone gets injured. Those are all things to be aware of. So real quick, we've got an unpaid HOA board member drives to the office supply store to print brochures for a meeting. He or she gets in a car accident and sustains serious injuries. This board member can file for workers' comp coverage, claiming the accident occurred while performing duties directly related to your association. Your association hires a new landscaping contractor. A day laborer working for this contractor injures himself while trimming a tree, and suddenly the HOA receives notice that the day laborer is filing against the HOA's workers' comp laws, and in this case, policy. So those are all things to be aware of. And again, just because you feel that your vendor may have insurance, they may not have proper insurance, or they may have let it lapse. So again, that's why these workers' comp policies are very important. And again, I'm sorry, I got lost there. And the big thing to be aware of here is the cost for coverage. So in North Carolina, we can obtain a $1 million workers' comp policy with, if any, coverage, which means that you get coverage for volunteers and you don't have any W-2 employees working for you. We can get you that policy in North Carolina for $540 a year, or in South Carolina for $615 a year, and that provides up to $1 million in coverage, which is a big deal, and especially when it comes to some of these claims that you see here and the amounts that pay out. For the nominal amount a year and workers' comp insurance cost, we can get up to $1 million worth of coverage, and that can be a big deal with regards to paying out a claim through insurance or just through the HOA's bank account. So there's some examples there of actual claims that actually paid out from one of the workers' comp policies that I use. All right, everybody. I appreciate very much you sticking with me tonight and being here to learn more about HOA insurance and bettering your community. If you have any questions, please let me know, and I'm happy to help or answer them to the best of my ability. If you have any specific questions about your specific association or something just real specific, I ask that you either reach out to me by email or phone so we can talk about that privately. So that way that we're not disclosing any personal or confidential information here tonight. But again, thank you all very much for your time and your help. And please let me know if you have any questions.
Hunter, thank you so much. I would just like to also piggyback on that. If you are one of Cedar's board members, you can also reach out to your community manager for questions specifically about your community. Is there an expert in your community? Hunter, we do have some questions here, starting with for D&O, on average, what is the cost difference between endorsement and separate standalone?
Yeah, so our minimum premium for a separate full D&O policy is going to be $750 a year. The minimum for the endorsement is typically closer to about $200 a year. If let's say that you're an association with 100 single family homes in it, your separate standalone D&O premium is probably going to be about $850, $900 a year, and it's going to be about $250, $275 on the endorsement. So again, while it is a pretty big difference up front in the long run, and when you look at the cost of claims and what the hourly rate of an attorney is, it really, really benefits you to spend the money up front and get the better policy.
Thanks, Hunter. If somebody threatens to sue the board members, should they let their insurance know immediately?
So I don't think it's ever a bad idea to talk to your insurance agent and kind of have, maybe even before the problem occurs, like with something like that, ask your agent's advice on that. Depending on the type of agent they are and the way that they're contracted with their insurance companies will kind of depend on the answer that they give you. An independent agent like myself, I contract with multiple different companies. And so what I can do is I can act a little bit more in an advisement role. So if you tell me something, I won't automatically just go tell the insurance company about it. So we can have a little bit more privacy there, and that's why it's best to understand the relationship with your agent up front to see if they can give you that kind of advice or if they're going to report anything and everything directly to the insurance carrier. But I will say any time you receive any kind of written demand or lawsuit, definitely the first thing you need to do after you've opened that email or opened that letter is forward it to your attorney and your insurance agent. But if someone just says, "Oh, I'm going to sue you," use your discretion there, because with my experience, like I said, as a recovering board member, I was told that a lot, and a lot of it was just people being a little bit angry with me and not really fully understanding things.
Thank you so much, Hunter. That's good to know. I've got more people private messaging me some questions. This one says, do our volunteers and committee members need insurance? What is available?
Yes, your volunteers, if you have volunteers and committee members, they definitely need insurance. Your endorsed D&O coverage is not going to cover any committee members. That's very important to be aware of. It's also not going to cover volunteers outside of your standard typical board members, be it your president, vice president, secretary, treasurer, and if you have a member at large, maybe. But your separate standalone policy is going to cover, any board members, committee members, subcommittee members. And so if you have any of those committees or subcommittees or volunteers, it's very, very important that you have that full separate D&O coverage. And again, also, if you have any volunteers, that's another reason why you should really think hard about that workers' comp policy, even though I believe that every association should have it. If you have volunteers, that's just one more reason solidifying why you need to put that policy in place yesterday.
Thank you. I have another one here that says our board is split and they want to hire a handyman who isn't insured. What do you recommend?
I would never hire someone that's not insured, and whether that means that they have their own insurance policy or you as a board have a way of protecting yourselves and themselves too. But I wouldn't just let any Joe from the side of the road, if you will, for lack of a better term there, just come onto the association property, because you as a board are not only putting yourselves at risk, the items which they're working on at risk, but everyone in the community's pocketbook at risk. Because if they get hurt, if you all are found liable and there's no insurance in place, that those injuries and lost wages are coming from the HOA's bank account. If there's not enough money from the bank account, they're going to special assess everyone in the association to be able to get the funds necessary. And that's just not worth it.
That makes sense to me. I have another question here. Does the coverage apply to the board members even when they change, or does it have to name a specific board member? Does it simply cover the year or after the year, or no matter who's on the board? How does that work?
So it's really going to depend on the exact policy itself. So be sure you talk to your agent about the specifics anytime you're reviewing any kind of D&O coverage. But typically it's going to be based on the position itself. And they're going to refer to prior board members as just prior board members. But there are a few companies that require you to put the specific board member's name listed on that policy or application for the policy. And so in those cases, when they need the specific person's name and position, anytime there's a change, that change should be reported. But again, it really just depends on the policy and the company providing the policy with regards to the intricacies of that.
I have another question here, and it says, what carriers are you using for the coverage, and what are their credit ratings?
So I'm going to guess that they're probably talking about D&O insurance with that. And my main two or three, I should say, folks that I use for D&O coverage are going to be USLI, which is United States Liability Insurance Group, Cincinnati Insurance Company, as well as McGowan Programs. That's a specialty company that's very good for D&O if you've had a claim or two or some real interesting, intricate, sticky situations. They are Cincinnati and USLI are both A-rated. I don't remember exactly what McGowan is off the top of my head because they have a few different underwriting companies, but I believe that they are all either, somewhat of a or A- rated carrier to my knowledge. But those are the three that I usually use most predominantly for standalone insurance. And then all of our endorsement D&O companies are going to be the same folks that are providing the property and general liability, which is going to be your auto owners, Travelers, Harper Mutuals, Nationwide, and the folks that you've more typically heard of that are going to be your A-rated companies or higher as well.
Thank you for giving us that information. It looks like I have two more questions here. This one is kind of a long one. It says, how do I know when to enforce our rules for one person and not for another? We have an owner in our community that has a white fence they've always had, but our guidelines require only black fences. What do we do in that situation? Do we allow white fences, or do we make the owner with the white fence take it down, or allow people everywhere to have white fences, even though it's against the guidelines?
Yes, no, that's a great question. And I'm going to preface it by saying I'm an insurance professional, not a law professional. So I'll give you my insurance opinion on it, which means nothing from a legal perspective. But I think it's going to lead you in the right direction. Do not do anything different than what your legal documents say that you're supposed to do. If your documents say that you're not supposed to have a white fence, then I would recommend finding a way to curing that solution. I would not continue to allow other people to have white fences if the documents say that that's not allowed. My question, I guess, more so would be, how did that white fence arise? Was it approved by a prior board, or was it just done by the owner? If it was approved by a prior board, then that's another big thing to go talk to an attorney about. But if it was just done by the owner, then I would assume that that's something that would likely be available for fine until it's corrected. But again, I'm just an insurance guy, not a legal guy. But what I can tell you is you need to follow your rules or properly have them changed, or you're going to get yourself in a big mess, unfortunately.
Thank you so much, Hunter. We respect your guidance there, even though you're not an attorney. So definitely, whoever asked that question, go ahead and talk to your community manager about it, as well as probably an attorney. The last question here I have is, and just so you know, Hunter, we've got about 6 minutes, so you can kind of budget your time for this question. What's your craziest or oddest claim you've seen with an HOA?
Ooh, so funny enough, it's actually one that I wasn't. So the most interesting claim story that I was involved in actually was one that I was not an insurance agent for. It was actually part of my board member time, and part of the reason why I prefer to stay as a recovering board member. But when I was a board member at a community here in the Charlotte area, there was actually a gentleman who decided. So it was a lakefront community down on Lake Wiley. We had a boat lot and marina and everything like that. Well, there was a gentleman that didn't live in the neighborhood, but was friends with somebody in the neighborhood that actually decided to put his boat in the storage yard and leave it there, even though it was against the rules and everything like that. So the boat had been flagged and tagged numerous times over about a 1.5 year period, and the guy never did anything about it. And so we finally removed the boat from the lot, had it towed and stored by the towing company, and the guy just went ballistic. I mean, I've never seen anything like it, to be honest with you. Just going on our Facebook page, just saying all kinds of nasty things about all the people there and calling the police on us. Then he tried to sue all of us, took us to court 3 different times over the situation. So I had to go to court and sit in small claims court over it. And it was just one of the craziest things I've ever seen in my life, to be honest with you, especially just because of how how easily it could have been prevented and resolved. And we tried to be so nice and give this guy a year and a half to move his boat, and kept tagging it, and he just kept tearing our tags off the boat and just leaving it. And so we finally towed it, as our document said that we should have done a long time ago. And yeah, it was not fun. He kept on, multiple times he submitted the paperwork to the court wrong. He was trying to act as his own attorney, refused to get his own attorney. So it was a circus show, to say the least. But that was probably the most interesting thing that I've been involved with, especially just coming from the insurance side, being involved with that and kind of seeing how unreasonable, to say the least, that some people can be over something so minuscule, that people just kind of dig their heels in sometimes and decide that they're going to do what they're going to do, regardless of whether it seems logical or not. So that was just one for me to realize, again, a good reason why I need to be sure to emphasize to clients about, getting the right coverage and about the value, as opposed to just buying the cheapest thing. Because if you buy the right thing and have the right coverage at a fair price, you're going to have coverage in place to deal with some of these crazies like this guy that I had to deal with.
That is absolutely nuts. I am so sorry you had to go through that. Hunter, we did have one more question that came in while you were sharing your story. Do you have time to go through?
Yeah, sure.
Okay. It says, could you give an example of third-party discrimination, which is excluded in the endorsement coverage?
Third-party discrimination of, okay, yeah. So let's say that, so I have an actual one I can kind of carefully talk about. So there, I had a previous current client of mine, actually, that had a situation like this arise. There was a board that was made up of a certain one gender and one race, and there was a family in the community that was of another race that felt that they were getting fined inappropriately. That they kept receiving fines for different things, whether it was, their grass was too tall, their bushes need to be trimmed, their whatever it was. They were just one thing after another, after another, after another. And so that homeowner felt that they were being discriminated against, not necessarily because their lawn was too long or whatever it was that the association was claiming, but they felt that this board that was made up of one certain group of individuals had an issue with them because of their race not being the same as the folks on the board. So that the homeowner actually sued the association, sued the board members, sued them all personally as well. And in that case, that discrimination was not covered by the association.
Thank you so much, Hunter, for elaborating on that. We will go ahead and move on to the raffle portion of our webinar tonight. Hunter's going to leave this slide up where it's got his email and phone number on there, so you can go ahead and write that down. And we went ahead and put everybody who came in a list alphabetically, and the numbers that we pulled, we've got 3 $50 gift cards that we're going to email out to these board members. We've got, we picked number 2, and that was Bill Oberst Jr. Bill, we've got your email, and so we will send that out. We picked number 9, which was Driskilla Gwen. We've got your email from your RSVP, so we're going to send you that $50 gift card over email. And then Mark Gupton. Again, we've got your email from your RSVP, so we will send that to you. And that actually concludes our evening together. Thank you so much, Hunter. I've got Julie Shadrick here, who also wants to say something to the board members.
Hey guys, I'm Julie Shadrick. I'm VP of Sales with Cedar, and many of you know me, and I just wanted to say thanks for joining tonight. Hunter, great presentation, very informative. I think it's what we all need to hear, even if we don't want to all the time. So thank you so much, everyone, for joining, and thanks, Hunter, for presenting. Thank you, Samantha, for hosting it as well. Have a good night.
Have a good night, guys.
Yeah, thank you all and have a great night. Big thank you to Cedar Management. Thank you all for your time and have a great night.